It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome to the Jill on Money show. It is the first weekend of June, and we are here to help take the mystery out of your financial life. I'm Jill Schlesinger, and Mark Talercio is my executive producer. He's listening in and will weigh in when he thinks it's appropriate. We're both certified financial planners. And what does that mean? It means while we don't do this for our day-to-day business, it means that we have both done what is, I guess, seems to be the gold standard of financial planning in terms of coursework and preparation. Now, for a long time, I was a financial planner and a money manager. That was after a career when I was a trader on Wall Street. I don't do that anymore. My full-time job is I work for CBS News, where I am the business analyst. But this show is about you. It's not about me. It's not even about my credentials. It's about trying to help you make smart financial decisions. And sometimes those decisions might be at a critical time in your life, and sometimes it may not be. Maybe it's just another set of eyes and ears, or two sets of eyes and ears in our case, to just get an idea about where you stand, if you're on the right track. Maybe something dramatic has happened. Maybe it hasn't. But regardless, I think a lot of us get in our own way when it comes to making financial decisions, very emotional. And sometimes it's nice to have an unbiased, objective person. And we're unbiased and objective because we're not going to sell you anything. We're not trying to be your advisors. We're just trying to help you make the next best decision in your financial life. We do that by asking you to actually do a little work. Just go to jillonmoney.com, you click the Contact Us button, and you ask your question. And then, of course, we'd love to have you on the air. And if you want to come on the air, you check a box. That's what Evelyn did. She's on the line from New York City. Hello, Evelyn. Welcome to the program. What can we do for you?
Hello, Jill. Hello, Mark. Thank you so much. This is exciting. Yeah, so me and my husband are looking a little bit in the future. He is going to retire in about 8 years. Our kids hopefully will be out of college in about 9-10 years. And at that time, we'd love to leave the city, live somewhere else on this beautiful planet. And we would like to have flexibility because we're not exactly sure where that will be and how that will all happen. And I was wondering if there are any things you advise for people who would like to, have some flexibility, and are there any thoughts on living elsewhere?
Yeah. I mean, you're saying live somewhere else, not in the United States. You're saying live somewhere else, like in the world, right?
Yeah. I mean, it could be the US. We really are. It will not be New York City.
Are you sound a little, are you like burnt out on NYC? What's going on, Evelyn?
No. I still love it. Love it. But I think in 10 years, we would love to be someplace warm.
Oh, warm. All right. Southern Hemisphere. Okay. How old are you?
I'm 46. He is 52.
Okay. Do you both work?
Yeah. He works for the city. He works for CUNY, which is the city university. Yeah. And I am a freelance photographer.
He works for CUNY. How much does he make?
He makes, before taxes and all that, $109,000.
109. In 8 years, when he's 60 years old and he's retiring, what is his pension?
As far as I can tell, it's all a little confusing, but I think it will be $65,000.
That's good. That's a nice base, right?
Mm-hmm, yeah.
That's pretty good. Will he also be entitled to Social Security?
Yes.
Okay. And do you have a Social Security benefit floating around anywhere?
The last one I can see is the one from a couple of years ago, which was $2,700 a month.
At his full retirement age, which would be like 67?
67. Yep, you're right.
Okay.
Mm-hmm.
Okay. So $2,700 a month. Okay, great. Now, you are self-employed?
Yep.
Have you saved some money in a retirement account?
I have. I have saved in a SEP IRA. I have about 205,000 of this morning. Mm-hmm. And then I just started 2 years ago a Roth IRA, which has about 12,000 in it.
Great. Okay. I forgot to ask, in addition to his pension, does he also make a contribution? Yeah. He does. So he has a defined contribution plan as well. So is it a 457 plan?
There are two different ones. He has the New York State Deferred Compensation Plan 457B, which has 50,000 in it. And then he also has a TIAA Tax Deferred Annuity Plan, which has 155,000 in it.
All right. I like it. I like it. Okay. Now, here's a big question for you guys. That is, do you have an idea about how much you really need to spend when we have this blissful 10 years from now? I mean, let's talk in today's dollars. Like, if you did not have your kids today, do you have a sense of what you might need?
If we wouldn't have tuition for the girls, it's probably 8,000 a month.
What happens in 8 years? You just like ditching out on your career or what?
No, I don't think so. I think we'll both be working in some capacity.
Okay. When I look at his stuff, right?
Yeah.
He has this 60, and it's probably going to be more because, you know, as you work in the pension system, your benefits should increase. But if we look in today's dollars, he's basically got $5,400 a month from the pension, then $2,700 a month from his Social Security. And then what's your Social Security benefit estimate?
Same thing, 2,700.
But you're young, so we have to wait to get that. I mean, so what that means is you kind of get covered. I mean, gross, right? Obviously. Oh, wait, does he get health care because he's part of CUNY?
He does.
Oh, that's great. Okay. So, I mean, you're pretty close to getting covered. I see why this could actually work. How old are the kids now?
They are 15 and 13.
Any money saved for college, or are they going to CUNY?
They do have a little saved. So we have, for the 15-year-old, we have about 25,000 in a 529. And for the little one, we have about 20,000 in a 529.
How much is the apartment worth?
The apartment is worth, after flip taxes and all that, 600,000.
Okay, so you've got pension, defined contribution, 457, TIAA, your SEP IRA, Roth IRA. What about money that's non-retirement?
So we have 30,000 cash, which is like immediate emergency, and then we have 60,000 in a brokerage account.
If in your best case scenario, right, it's 10 years from now, 10 years from now, the kids are done with college, you've sold the apartment, you've paid your flip tax, you got 600 grand in cash. That money you would use to kind of supplement the pension that your husband would receive, because you need sort of to pay for the gap between the pension kicking in and Social Security kicking in, right? Correct. And so yeah, you could do that. I mean, you wouldn't buy anything. If you move somewhere else, you wouldn't buy anything. Okay. That's sort of number one.
Probably not.
Yeah. Okay. So you use some of that cash up. I don't know. You're not that far off. It kind of depends. Like if you want more security, if you want to do this and you feel like a little like queasy at the time, he just keeps working. That's kind of how you would make yourself feel better. There's no reason why you can't do this. The issue, it would always be that you need liquidity. But if you're willing to sell your apartment, you've got liquidity. So that seems fine to me. We'll get back to Evelyn in just a minute. If you'd like to join us, again, JillOnMoney.com. That's the website where all of our content lives. We'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back. It's Jill on Money, and we are here answering financial questions, giving a little advice, maybe putting a little hand on your back, trying to prop you up sometimes. Often we will hear from you guys, and we really do appreciate that. If you would like a little more of Jill on Money, if you'd like to experience us in a couple of different ways, we encourage you to go to our website and check out our 2 other audio broadcasts. They're podcasts. And so it's very nice because if you're not familiar with the podcast world, all you need to do is go to JillOnMoney.com. You click podcasts, and we have a link to help you learn how to subscribe or to follow us. it's kind of cool because the Jill on Money podcast, it comes out every single day. It's much shorter than this show, but, bite-sized little versions of Jill and Mark. It's pretty good. And then we have another broadcast. It's called Eye on Money. That comes out twice a week. Again, all the links are on the JillOnMoney.com website. While you're on our website, I also would love if you would sign up for our free weekly newsletter. The newsletter comes out every Friday. Mark collates all the different stuff going on in the financial world and distills it into a nice, neat little weekly summation. And I think you'd really enjoy that. Many people like you have actually subscribed to it, and it is free, and it comes out every Friday. So go check it out. Okay, now we are going back to our conversation with Evelyn from New York City. And she first contacted us wanting to understand whether or not she was on track to retire and relocate. So let's get back to our conversation with Evelyn. I guess the only other thing is that, you're underfunded for college, but what's the game plan for college? Are you saying kids got to go to public school or what? What's the hope here?
Well, the hope, all their schooling so far, they have been at private institutions with incredible financial aid. They're great students. So the hope is that could continue. Yes, amazing financial aid, but New York City prices, we still pay $25,000 a year. So we still, with our incomes as they are right now for the next 10 years, hoping all goes in the same direction, we would still be able to afford $25,000 a year.
All right. I mean, that sounds good. And also you said you're willing to work some, not full time, but you're going to work a little bit, right? Okay.
Absolutely.
And you could take it for you, it's a kind of, it sounds interesting because you could take a project when you want and you could do that from anywhere or what? Are you limited?
Well, who knows what I want to do in 10 years? I'm not sure if I could be something completely different. I could go more digital and do more retouching or things like that. So I will keep learning and keep on it, and we shall see. But I will want to work. I got
to tell you something. I need some retouching right now. It's funny. I looked at Mark and was redoing the website. He's like, send me some pictures. So a very dear friend of mine is a photographer, and she sends pictures. And I said, Carrie, what's with those lines? Get rid of them. She goes, those are wisdom lines. I said, no, they're wrinkles.
That's funny.
So you can use that anytime. So, all right. I think you can do this. I'm on board with it. It sounds like a kind of a cool plan. Listen, if you're going to another country versus another part of the United States, there are some issues just about making sure that you have accounts that are set up in the right way and that things are sort of automatically done. But, there would be a lot more information you'd have before you pull the trigger on this game plan. You've got to figure out where you want to go. Give us the top 3 right now of where you'd want to go.
So there's the whole Costa Rica, Mexico area. Mm-hmm. Then it could also be the southern side of America. It could be Arizona, for example, or Portugal, for example.
What languages do you speak? So you're European, so it just automatically you speak many more languages than the dumb Americans. So why don't you give us your rundown of so do you both speak Spanish?
Well, he only speaks English. He's the American. But
for God's sakes, how could you? You really married beneath you. We know this. Evelyn is German by birth, and we're going to have her do the introduction with my name in a second. But so you speak English, German. What else?
French and Spanish to a working knowledge. I wouldn't be able to have this conversation in English or French or Spanish, but English and German I speak fluently.
Oh, Evelyn wrote in and she said she's got an account that's labeled, not TIAA, but it's a different account. Is this where the SEP IRA is? Where is this?
Oh, right. The SEP. Oh, okay. This is a good segue to my other question that I had. So yes, it's a SEP IRA that is with a company called Cetera.
What's that? Is that like an investment advisory firm?
Yes, it is.
Okay.
And that is that to me, because just in preparation for this, I was downloading the statements and everything. That is a big mess.
That's a big mess.
It seems to me. I mean, it's just like this jungle of funds and things. And I'm trying to figure out how much do I pay for it, and I can't tell. Anyhow, but I was thinking I'm changing my company from LLC to an S Corp, which allows me to open a solo 401k.
You can open a solo 401k as an LLC. Do you know that? Yes, you can.
Oh, I didn't know that. Wow. Okay. So I can, so I will, I want to do it now, thinking that I can put more money into retirement with that option. Is that
Yeah.
correct?
Yeah, definitely can. But I mean, you don't need to put so much more into retirement. Don't worry about it. You're going to be okay, but you can. And you want to get rid of the Cetera and their weirdness?
Yes. It's just too much. Listening to your show, I mean, just if I look at this, it's like, I don't know, it's like 3 pages of individual funds.
Forget it. Move it. Move it. Move it. Move on, sister. So, yeah, let's get rid of that. Let's go. You can go to Vanguard. Where's your Roth?
Fidelity. I have a Fidelity.
Okay, good. So just move this SEP to Fidelity. Yeah. You can just move it over. In fact, I mean, you can just move it as is. You don't have to do anything. And then Fidelity will help you open a solo 401k. And you can do it. You can keep it. You can keep an LLC. There's not a problem.
I know on the show you've talked oftentimes about TIAA and how much you like them. I would have the option to get into TIAA through my husband.
Yeah, you could do that too. I mean, but I don't want, if you like Fidelity, it's fine. You know what I mean? Like, it's not a problem either way. And so if you can use it, sure, you can use TIAA craft. It's great. And if you want to just do it at Fidelity and keep these two separate for now, fine. That's also fine.
Yeah. If I would just get like a target date type situation, just to keep it super simple.
Well, what do you mean? You got $200,000 in the SEP. You mean that we can do better? Mark, can you give her the allocation for $200,000 in her SEP, please?
60% in a S&P 500 index fund or a total market index fund. You can have, maybe 15% in an international stock index fund, and then the rest in bonds.
That's it. Intermediate term bond fund. Boom, done. 3 funds, easy peasy.
Yeah, that would be so much easier. I mean, now it truly is a...
and you're paying, look, put it this way. You're paying, we don't know what you're paying, but you're paying something. And whatever you're paying will fall to your bottom line. So you might as well just, let's keep that moolah, baby. Let's keep it.
Exactly. Mm-hmm.
Right?
Yeah, I agree.
All right. Mm-hmm. I feel good about this plan. I'm going to come visit you. I mean, Portugal's hard. Portuguese is a very hard language. I have a niece and a nephew who are half Brazilian. And I'm going to tell you something. That's a weird language, and it screws with you if you speak Spanish. So I think that Costa Rica, Mexico, or Arizona, I'm on board with. Although I'd like to visit Portugal, where I've never been.
Well, how about Spain then? We'll go close to the Portuguese border.
Yeah, maybe. I don't know. Portugal's supposed to be pretty awesome. Let's keep in touch. Let's keep in touch. Okay, now, before we go, you have your estate planning documents. You got a will. You got a power of attorney. You have a healthcare proxy.
We do. All of that is 15 years old because we did that when we were pregnant with our first child. So it's time. It's time to look.
All right, you can update it. It actually gets easier as they get older. It's not a problem. The guardianship starts to be less of an issue. How about life insurance?
Yeah, we both have $1 million for the next 15 years.
That's perfect. That seems good to me. You see how easy it is to kind of get a big picture overview of the various financial issues in your financial life? All you need to do is go to our website, jillonmoney.com, click the Contact Us button, and of course, do not forget to let us know if you would be willing to come on the air live. There's a little checkbox at the end of the form. Now, if you are shy and you don't want to come on the air, that's okay too. But if that's the case, be sure to give us a lot of detail in your note. That way we can hopefully answer your question. In fact, just bookmark jillonmoney.com. All right, we will be right back.
.401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back. It's Jill on Money, and we are here to try to help you make the next best financial decision. I say that because I think sometimes you guys are awfully hard on yourselves about the things you did or did not do in your past. And I'm not saying that we don't all screw up in our financial lives. Of course we do. I think the key is, how do you move forward in whatever stage of life you find yourself? And that could mean that you want to figure out how to jumpstart retirement savings. It may be that you've gone through something chaotic and disruptive in your life. Maybe it's a job change. Maybe you've changed your marital status. Maybe someone has unfortunately died in your world. All these events can bring up different financial questions. So we encourage you to hop on the website, JillOnMoney.com. Click the Contact Us button. That is what Scott did. He's on the line from Washington State, that is. Scott, welcome to the program. What can we do for you?
Thanks, Jill. Good to be here. And it's Washington.
I know. Okay. Washington. That's an old East Coast thing.
That's right.
Okay, Washington State. So already we know you live in a nice place and it's probably expensive. So what's going on?
Well, I've been working a long time, 30 years, same company, living below my means, investing, even taking in roommates. I'm just kind of ready to retire.
All right. Well, how much do you earn right now?
Well, that's come way down. I stepped from outside sales to inside sales, so I took a pretty big pay cut, and I'm down to about $100,000 a year. And then I've got some renters paying me about $1,500 a month, and I've got a nice stock portfolio with interest. I'm trying to build that up so I can just depend on interest.
How old are you?
I'll be 59 very soon.
I just have to assume that you are not partnered because you have renters in your house. Is that right?
Yes and no.
Oh, do tell. Tell me more. This sounds like a good story.
You
I'm
want to get
excited.
into this? Separate.
Oh, you're separated. Yeah. I'm sorry. That's
maybe sort of reconciling. I'm not quite sure.
I've always liked those nice stories. But, nothing wrong with a little time off to review, to consider all of those things.
Yes.
Let's just presume that you could retire right this second. Would you stop with the renters? Would that be
no, I don't think
so that's something we're going to continue. Okay.
Yeah.
And they're in your home, or is it a different dwelling?
Is
it okay? Got it. Okay. Yeah. You must have a nice house. How much is your house worth?
It's a big house, 3 floors, 3,300 square feet. I'd guess it's worth 1.4.
All right. And do you have a mortgage that remains on it?
I do.
How much is left?
288.
Oh, that's nice. What's the rate?
2.5 variable. I did interest only for many years and just took the money I saved and invested.
Yeah, you're killing it now because you're like, oh, even if the rates go up a little bit, you've got time. How much is in your brokerage account?
What day is it?
It's just a day that ends with Y. Give me the approximate value.
About 1.6.
Oh, that's good. Okay. And what about retirement accounts?
About 1.6.
1.6 in both retirement and brokerage?
More or less. Yeah.
Oh, wow. Okay.
Then I got cash, about 150, an emergency fund, and some gold.
Gold? Interesting. Is the retirement account a pre-tax account or a Roth account?
I got a little traditional, a little Roth, and a 401k.
Okay. How much is in gold for real?
About 60 grand.
How much do we need to generate from your accounts to float you? What's your need? What's your retirement need?
100 grand would be nice.
What do you mean? You're only making 100 now, and you're putting money into retirement, so it's less than 100.
I live pretty close to the bone.
Okay. All right. So you need 100 grand pre-tax is what you're telling me.
Yeah, I'd say so. And I'm on travel.
Okay. Is there any pension that's in your future?
No.
What about Social Security benefit?
67 would be 3,300, and then 70 would be 4,100.
Anything else that I should know about?
The stocks, I'm almost all stocks, U.S. equities mostly, highly diversified portfolio, but probably a little riskier than you'd like. Okay.
But it's okay for you?
Yeah.
All right. I mean, you'll have to shift that, obviously, if we're going to stop working. Do you really want to stop like now? Is the clock ticking for us right now?
Well, there's a lot of changes come up in my job. I'm doing the same thing for 30 years. I'm kind of burnt out. I'm getting older. If I've got the money to enjoy life, why not?
Okay. You got kids or anything I got to worry about like anyone else?
I got one grown daughter through school, no debt.
Now, what happens if this relationship gets back on track? Does the game plan change then?
A little bit. She makes money, has her own business. She got some money sacked away. She's a Spanish citizen.
Mm-hmm.
So we probably live over there part time. I could get the health care there.
Mm. So let's just say you wait until you're 67 to draw your Social Security. We'll use that as like your baseline. So we need 7 years of $100,000, right? And you'll have to use the brokerage account essentially to fund that, right? You know, I'm sure that you have some capital gains on this account. So I am presuming that, I mean, I'm just going to do some simple math with you, that probably if you sold, if you sold out a little bit at a time and you fund your $100,000, we're going to deplete that. It's going to go down to $500,000 or $600,000 at the end of the terminus of this little era, the 60 to 67 year. So you're going to end up with, let's say, 500 grand in there, and you will have spent the money to finance 60 to 67. I'm being very conservative. And then at 67, you get your $3,300. Okay. And of course, you do have the rent, but I'm not really including that right this second. We'll get back to Scott in just a second. During the break, here's a very easy ask. Go to JillOnMoney.com. That's our website. And simply bookmark that site so you can come back to it whenever you have a financial question. Jill on Money. We'll be right back.
Follow Jill on Twitter and Instagram for more personal finance content. Just use the handle @JillOnMoney. Now, back to the show.
You're back. It's Jill on Money, and we'll get back to our conversation with Scott from Washington State in just a second. I want to just remind all of you, when you hear the conversations we have with people, some of it is applicable to your life, but a lot of it is just dependent on your own financial situation, your own circumstances. And that's why we really encourage you to get in touch with us so we can drill down and give you the best options for you, not for someone else. So if you'd like to come on the air with us, just go to JillOnMoney.com and click the Contact Us button. We'd be very appreciative if you did that. And let us know if you would like to come on the air live like Scott. So we're going to continue our conversation from Scott. Let's go. So then at 67, you can start pulling down a little bit less than that much money out of the brokerage account. But it seems to me that you're going to sort of deplete that account generally.
What about the 4% rule?
Yeah, I mean, 4% is not a great rule depending on where interest rates are. Let's say it's 3%, okay? And then you'll see you're going to start digging into that account. And that account is all stocks right now, and it cannot be all stocks when you start needing your money. You're going to have to go into cash for chunks of it at a time to finance this.
What about REITs and pipelines, big dividend pairs?
Yeah, you could have. Yeah, you could have that. Yeah, I mean, you could have that. There's risk in all of that, right? Do I think you can do this? Let me just go big picture. I actually think you probably can do it, but you have to be willing to spend down your assets. And if you're willing to do that and you're willing to screw your grown daughter out of any money, I'm only kidding. And whatever. She sounds like she's on her way anyway. But like, I think that you probably can do it. I think that there's a way to make it easier on yourself. So you want to know the various ways to make it easier on yourself is number one, keep working. Well, even though you're tired, you could sell your house. You could sell your house, cash out, rent yourself and have a big chunk of moolah. Live in Spain some, live in Washington some, whatever, and you'll have more money available to you. That's the way the plan looks better to me, but you have to be willing to do that. I feel like you're a tiny bit close. Mark, do you disagree with this? Do you think he's in better shape than I'm painting?
I'm just curious, the rental income, like if he's in Spain, are they going to rent the whole house out? What does that look like?
Yeah, could you rent the whole house out?
Yeah, that's a good question. Yeah, probably about $4,000 a month.
I like that.
Big house near good schools.
Well, but then of course you have to live someplace when you come back. They're not going to rent it for 6 months at a time.
The wife has a really nice brand new condo.
So this separation, I have to say, is very bad for your finances. It would be much better if you got back together. So let's go back. Let's go into that upside of that scenario.
Okay.
If she's got her own money, she's got her own place.
Yes.
Then you're golden. So figure out how to make it work. Spend some money on therapy, and then you'll be in good shape.
I know.
I think on your own, you're a little close. It's like what we call in Wall Street, you're sort of pricing this to perfection, and you're not giving yourself enough wiggle room. Because look, I don't know what's going to happen. I don't know how the markets are going to perform. I don't know what happens to your oil and gas partnerships when the price of oil goes from, 120 to 150 to back to 80. It's so hard to say. If you could work for a little bit more, that's one thing, which would help you, obviously. If you could sell the house and get liquid on that, that would help you. If you could rent the house and get more money coming in every month, that could be good for you. It's interesting. It's like you've done a very good job of saving, but because your retirement need is this $100,000 a year, don't forget all that money that's sitting in the 401k hasn't been taxed yet. So I got to pay tax on it. You don't have 1.6 million. It's less than that because you have to pay tax on it.
That might be too high, Jill, but I'm trying to factoring in having to pay my own health insurance. And then if I reconcile, that's a no-brainer, right? No-brainer.
Oh yeah, right? No-brainer. No-brainer. Okay. So figure out how to make it work. Yeah.
Okay.
Yeah. Figure it out, dude. Figure it out. Now, it sounds like you know what you're doing with your investments. You've got an idea, at least, that you think you know what you're doing. Be more conservative than you're being. That's what I want to encourage you to do.
Bonds?
No, I'm just saying in general, with your assumptions and life has been good for you for the last 30 years. You've been an investor in an incredibly vibrant 30-year period.
Yes.
Right? So let's downgrade what you think can happen in the future and then see if the plan works. If you do that, then you'll end up where I am, which is you're pretty close. Oftentimes when I have these conversations, it's like I price to disaster and then I work backwards. And you price to perfection. So somewhere in the middle of the two of us is something. The reason why I price to disaster is that I'm too much, I'm worried for all of you guys. And I have to look at what if it was the 10% scenario where the blank hit the fan? I would be worried about that. So I want to put you in a place where you don't have to price to perfection. And you can put yourself in a place where I don't have to price for disaster. You got some wills and you got some power of attorney, healthcare proxy. Going to make sure your daughter gets it if you walk out on the street right now and get hit by a bus.
I got a will, not the other stuff.
Get a healthcare proxy and get a power of attorney. Healthcare proxy is actually more important when you're 59 years old. And, since we're in sort of the same age-ish, late 50s, that's when bad things happen. And you want to make sure that you have something documented. And living out of the country is right. Okay, if you are wondering what is the best path for you, for your retirement, for your kids' college planning, for taxes, for maybe a home purchase, maybe you should keep renting. All of these things are questions we all face in our lives. So why don't you give us a holler? JillOnMoney.com. That's the website. That's where all of our content lives. We refresh it all the time, and you can ask your question. We'll be right back. You're back. It's Jill on Money. And before we clean up the first hour and conclude it, we're going to answer an email question. Of course, we have tons and tons of emails lined up. If you want to ask your question, the faster way to get a response would be to say you'd come on the air, but we try to do emails also. So this is from Susan, who says, I see that we are calculating inflation as an increase in prices from last year at this time. But we were just coming out of the pandemic with vaccines being plentiful at this time last year. So weren't prices deflated because of everyone and most businesses being closed? We're equating it with the 1980s, but we weren't coming out of a pandemic back then, and there were very different circumstances that were causing inflation. Why isn't anyone pointing that out? I know prices are really high compared to what we are used to, but I wonder what the actual inflation rates would be if we calculated it from the same month in 2019 when the economy was more normal. This is a great point. I'll give you a good example of where we see this. It's not everywhere because inflation rates are running pretty hot. But let me think about it in terms of, say, rents. If you look at rents nationwide, the rental increase from a year ago was up almost 17% through April. Now, that's a massive number. But if you go back and you say, okay, let's look at 2020 to 2022, rents are only up like 6 or 7%. So you're right. If you go back to before the pandemic, it is very different. Unfortunately, for a lot of parts of the inflationary story, even when going before the pandemic, we are seeing big price increases. So everything from food and gas and other parts of the economy are feeling the pain. Two reasons. One is that surge in demand, but also the constrained supply. So we're going to have a fantastic guest next hour who is going to explain everything about inflation as well as the bond market. So stay tuned. Hour number 2 of Jill on Money is coming up. We'll be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
You are back. It's hour number 2 of Jill on Money. And boy, do we have a fantastic guest this hour. It is Kathy Jones, who is the Managing Director, Chief Fixed Income Strategist at Charles Schwab for the Schwab Center for Financial Research. She is a super smarty pants. She also knows so much about the environment in which we are living right now, which is this idea of high inflation, but also high inflation amid a moment when the Federal Reserve is raising interest rates. We got back in touch with Kathy. She had been on the program with us a couple of years back because we wanted her help in understanding the bond market and what has happened to it. We've heard from so many of you who are really freaked about the bond market, how prices have gone down, what to do with your positions, should you bail out of the bond market, all these questions. I know they're really tough. So we thought, you know what? Let's bring an expert on, because an expert is one of those things that we can bring to you, and we're happy to do so. So here's the first part of our conversation with Kathy Jones. Kathy, I looked it up. The last time you were with us was July of 2020. And boy, has the world turned over in this almost 2 years. So what did you do to the bond market, Kathy?
Well, I wish I had so much influence that I could move the bond market. But, you know, we came out, if we look back at 2020, that was really the depths of the pandemic problems and the shutdown of the economy. So many questions about how we would recover, when we would recover, whether we would recover. And then, of course, things started to pick up and really rebound pretty rapidly late last year. And that's when we started to see the Federal Reserve say, oh, you know, things are looking good. And oh, by the way, we have a lot of inflation and we're going to start hiking interest rates. So, yeah, huge change over the last couple of years.
So let's get you on the record first. Number one, did the Fed wait too long before it kind of got religion on, inflation's here to stay?
Yes, in hindsight, they did. I don't particularly blame them. It was a sort of fog of war situation at the time. There were huge uncertainties and questions, a lot of things going on. So I don't blame them for it. But in hindsight, yeah, they should have started raising rates a couple of months earlier.
All right. So they didn't. And here we are. We are where we are. And Kathy, we have so many people listening who own a whole bunch of bonds and bond index funds. And they are consistently asking this question: should I bail on my bonds? What is the answer?
Well, I think the answer is no. It has been a brutal couple of months in the bond market. And we saw something we don't often see, and that is like a parallel shift up in interest rates, meaning from short term rates pretty much to 30-year bonds. All of them just went up. And that's because the Federal Reserve is starting to raise rates. But having said that, this is the stage of the game where bonds will probably start performing better because they still generate income, they still provide diversification from stocks. And now that the market has adjusted to this new rate environment, to this new Federal Reserve policy, chances are going forward that you get more benefit from increased income from bonds to offset the price decline that we've seen.
All right. So make me feel better right now about the mark to market that we see in our bond positions, besides the fact that, listen, I understand conceptually that the damage, most of the downside damage has been inflicted. What about inflation? What about the income that I'm receiving? Will it keep up with inflation? What's your view on that?
Well, we are looking for inflation to come down over the next couple of years, and that's really the point of Fed policy, is to bring inflation down. That's really all they're focused on now, and they have the tools to do it. It may come at a high cost to the economy, but I do think that we will see inflation coming down. But I'll also make you feel a little bit better about your bonds with just, two words: bonds mature. So if a price of a bond starts at 100 and it trades down to 95, when it matures, it will mature at 100 unless there's a default. So bailing out now probably doesn't make much sense because you're just locking in a loss.
What's your view on the difference between folks who own individual versus bond funds? I mean, so let's talk about the person who is currently in a bond fund, say inside of my retirement account. The drop in price is probably good if you're reinvesting your dividends, right?
Yes, correct. So let's take that theoretical bond again. So say it starts at par at 100, it drops to 95. Maybe the starting yield was 2%, and now the current yield on that might be closer to 3%. So if you're reinvesting at a higher rate. And over time, your average income will appreciate. So again, this is kind of the time when it's hard to do, but hanging in there, as long as you have high quality bonds and you're not worried about defaults, hanging in there makes sense.
What about if you're already retired and you are like very excited about getting some income from this portfolio? You're not reinvesting. You need the money, or you need to take a required minimum distribution. What about the person who's not reinvesting? Is that person okay right now, or is there some change that investor should make?
Well, I think the investor's okay. There's an opportunity, though, here for someone who is really just focused on earning income. So it may make sense to rearrange your portfolio to capture some of that higher income. And again, it really just depends on what bonds we're talking about and the individual's circumstances. But it could make sense to shift around the portfolio a little bit to capture that higher income stream. I mean, right now we're looking at municipal bond yields that we haven't seen in many, many years. Very attractive for our higher income folks.
Especially if you live in a high tax state like in New York or California, where, that could be really interesting. What is your view on the folks who are now almost like reacting to what has already happened. So we're at 40-year highs in the inflation rate, near. And now all of a sudden I'm getting people who are like, should I buy tips? Should they?
Well, tips have pretty much discounted a lot, I think, of what's going to happen. Tips are attractive when inflation is low. They're always, I think, a reasonable part of an allocation. I wouldn't, though, jump into tips at this stage of the game versus other bonds because they've already kind of priced in what's happening here. So you would probably need to see kind of accelerating inflation from here for tips to do better than, say, just a normal treasury bond. So we still like having some allocation because it is good always have that inflation hedge in a portfolio, but I wouldn't be increasing it right now.
We'll get back to our conversation with Kathy Jones in just a second. It's Jill on Money. We'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back. It's Jill on Money, and we are talking about the bond market. I mean, we're talking about the economy overall, but I think that specifically we're trying to help you understand why it is that a portion of your portfolio, specifically the bond portion or the fixed income portion, has had such high volatility. I know for so many of you, why are you buying bonds? To actually not have that kind of volatility. That's so hard when, we go into these moments where things move around a lot. For those of us who have been around the block a few times when it comes to financial markets, I don't think that there is a full-blown panic that is bubbling underneath. I really think what's happened is that for some of the people like me and our guest Kathy Jones, sometimes we go through these very long periods where the markets are not volatile, and that can actually be a little scarier for folks like us. Because, listen, when you're an investor, things go up, things go down. I know that we went through a very volatile COVID period in, let's call it the end of February to the third week of March of 2020. In that period, what did you see? You saw stocks just collapse by about a third, but they came roaring back. And I think many of the people listening to this are used to having that kind of a pattern where things collapse, but then they bounce right back. We may be entering a period where that's not necessarily going to be the case. I'm not putting that as like, my prediction. I'm just saying we have to contemplate that. And often when we are investors, we want the best case scenario. Of course we do. But there are so many times where you are challenged to sit still and not to do anything. So I think that for a lot of you, when you went through this very, very low interest rate environment, you were bummed because you're like, I'm not getting any money in my checking account. So you would think about bonds, but then you went for higher risk bonds. So you may not have realized the danger in that. So in this part of our interview with Kathy Jones from Charles Schwab, we're going to talk about higher yield or junk bonds. Here is the next part of our interview with Kathy Jones. I feel like a lot of times when everything sort of feels like, everything's fine, even though this was not a fine time in the world, like the COVID era was super scary. But because yields fell so low that every global central bank dropped their interest rates to essentially zero and yields fell, it was at that moment that so many people started reaching for risk. So when is it a time that you think it's worth taking the risk of a higher yield or a junk bond? Meaning that what is an investor to look at as some of the signs on the horizon that maybe it is time to dip your toe in the water of the scary stuff.
Yeah, when it comes to the junk bonds or the high yield bonds right now, this doesn't seem like an opportune moment. So we usually look at it. It does well earlier in the cycle as we're coming into a growth spurt. So these are smaller companies, generally weaker balance sheets, maybe not great cash flow, maybe negative cash flow. They're very growth oriented. And so you want to think about junk bonds when those yields are high relative to, say, treasuries, and we're coming into a growthy kind of economic environment. That's when taking more risk makes sense. We're in kind of the late stages of the cycle now where the Fed is tightening. We're looking at a slowdown, and the extra yield you get versus treasuries it's moved up, but it's not huge and by historical standards. So I think you want to look at it along with the economic cycle or the business cycle, much as you would look at, say, a small cap stock.
Okay, so now if you're talking to a lot of the people who are listening who are they're freaked out, okay? They're definitely freaked out. I get it. What is it that those folks need to know about economic cycles? I mean, you keep mentioning that there are cycles. We do go into recessions, we go into growth periods. How long does, a run-of-the-mill recession, which is maybe caused by higher interest rates or inflation, how long do you think that could last?
Every recession is a little bit different. I like to, if you're familiar with Tolstoy's Anna Karenina, he starts it with us, all happy families are the same, but unhappy families are, unhappy in different ways. I'm paraphrasing. And
Yep.
I feel that way about recessions. They're out of the ordinary, and each one of them is a little bit different. But they tend to be relatively short in duration, maybe a year or so. And I think the kind that we may be going into, if we do end up in recession, will be very similar to the kind of recessions we saw in the early 80s that were due to, really tight monetary policy. If you remember the Paul Volcker era, when he had to raise interest rates a lot to fight inflation, we went into two very sharp double dip recessions in the early 80s. But once that inflation came down, things started to improve. So if I were to try to map out what might happen this time around with the recession, I think it would be pretty sharp, but it probably wouldn't last that long.
Tell me a little bit about what you think is kind of the likeliest scenario for not just bonds, but coming out of this, what you think the economic cycle could look like in the next iteration.
Well, I'm relatively optimistic, and the reason is that the underlying fundamentals for the economy are really pretty good. The consumer is not over leveraged, overburdened as, say, in 2008 when we went into the financial crisis. The housing situation really damaged a lot of people's wealth and balance sheets. And so the recovery was very slow. And then we had a damaged financial system, banking system on top of it. So we had a really long, slow, prolonged recovery. This is very different. The banks are in good shape. They're well capitalized. Most consumer indicators are still okay in terms of, their debt levels relative to income. We still have a healthy job market. People have built up some savings. So I think once we're through this period of high inflation, the rebound could be, a pretty healthy rebound. I see no reason why we wouldn't go back to a pretty healthy economy.
Do you think the labor shortage that so many, say, like in the leisure and hospitality or retail sectors are feeling, do you think that could be contributing to some of the wage pressure and some of the earnings misses that we're seeing? Do you think that will reverse itself if we do go into a recession?
Well, I don't know that it would reverse. I mean, so typically what happens, right, if you go into recession, unemployment rises, I would expect that to happen, and wage growth tends to slow down. But below the surface, that's kind of an aggregate reading. Below the surface, there are going to be industries that probably still will need to attract workers, while other industries will have too many workers. And so there's this resetting of the job market that happens. So I don't know. I mean, I'm hoping people can hold on to their raises, frankly. We had a long stretch when people's earnings were way under, the productivity growth in the economy, and now they seem to be catching up a bit. We don't want accelerating wages to fuel more inflation, but I'm hoping that we get a redistributed job market where, higher wages attract people to certain industries where there's still shortages, and then probably you'll see a slowdown in wage growth in other industries that have been, kind of sailing for a while, and we'll have to rebalance.
We'll get back to our interview with Kathy Jones in just a moment. If you've got a question about your bond portfolio, go to JillOnMoney.com, hit contact us, and we'll get you on the air. The Jill on Money Show will be back in just a moment.
.401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back. It's Jill on Money, and we are here talking about the bond market with expert Kathy Jones of Charles Schwab. And we wanted to bring Kathy on because we know that the bond market has been having a very rough 2020 so far. But, so much of the bond market is predicated on what's going on in the economy. And a lot of that has to do with, is the economy running hot? Is it running into maybe headlong into a recession? The theories are out there. We don't know yet, but we thought it was really a good time to bring Kathy on the program to talk you guys off the ledge and give you some perspective. So here is the next part of our interview with Kathy Jones of Charles Schwab. When you think about, what this economy has been through in the last 2 years, is it fair to characterize it as saying like, wow, actually this economy was incredibly resilient? Like in some ways, I think we are where we are today because of how quickly government and the Fed was able to respond. And maybe they did too much, but I'm not sure I would have wanted it to be that everyone suffered together and we actually were in a deeper recession in the COVID recession. Is that a fair way to characterize it, that we're almost a victim of the short recession and how quickly money moved into the system?
Yeah, I think that is a fair characterization. We had, an amazingly strong fiscal response. We had an amazingly strong monetary response. And given that pandemic was not really in the playbook for most economists, it was very doubtful about how quickly we could recover because we didn't know how quickly we'd recover from the healthcare crisis. And yet we did recover, and we recovered very strongly and very fast. And that, I think, is what's taken us by surprise. We've got inflation because supply and demand are out of balance. So demand has bounced back because we had such a big response that boosted the economy before the supply was able to come online. And that's where we are now to kind of rebalance that.
Okay, what keeps you up at night, Kathy? What are the things that you worry about? Not that you're a big worrier, but what are you concerned about today?
This will probably surprise you coming from a bond analyst. I worry about cybersecurity. I think that that's a place that, we've put a lot of emphasis in the government and in industry on it. But I do worry that there are vulnerabilities there that we're not all sort of prepared to deal with. And I think the other thing is I worry, I have young adult children. I want them to know that, I want them to understand that it is possible to go through these sort of very difficult time periods. I think there seems to be a lot of doubt and a lot of fear out there. All of us who've been around a while have been through a lot of these different events. And I worry that they're not as optimistic as they need to be.
That's so funny because Mark and I always joke. I said, when markets roll over, it's when I'm usually in the best mood. Because you're right, though. It's true. Like you go through these periods. I started trading. I graduated from college in 1987. I was a gold, silver, and copper options trader in the summer of 1987. Metals were roaring ahead. And then we had the crash of 1987. And, that was like my first taste of, wow, this is scary. And then you realize if you can just sort of endure it, it's not as scary the next time and the next time and the next time. And so I agree. Like I was pretty scared during COVID, which was a health crisis. I wasn't so scared about the financial markets or even the economy because you sort of have the sense that things will come back. I'm also wondering now, as you look at the investment horizon, there's just countless amounts of analysis from some people who probably should know better. This is going to be a lost decade in the decade ahead. Can anyone really predict investment returns in the decade ahead, Kathy?
No, obviously not. I mean, if we could, life would be perfect for everybody, right?
Yeah.
We do our best, and forecasting is what it is. You give it your best shot, and you try to be fact-based and not what I call faith-based. Put your money on the kind of factual information that you can derive. But we're human beings, right? And we drive the markets with our emotions and with our reactions and things like that. And that's almost impossible to predict.
Do you think that leading into, say, let's wind the clock back to 2021. We came off this 3-year period for financial markets, stock and bond markets that were pretty sizzling. If that were the case, if you looked at the previous 3 years, was it easy, hard, medium difficulty to predict that there would be some sort of slide back?
I think those of us who've been around a while were expecting it, right?
Mm-hmm.
You get these outsized returns over short time periods and then a reversion to the mean. As soon as we started hearing the Fed talk about the need to tighten policy, it was pretty clear that things were going to change, and that what's going to change is, the most vulnerable things, the priciest things, the most speculative things. Those are the things that usually fare the worst when real interest rates are moving up and cash has some, payoff. So it wasn't that hard to see. It's always hard to time it, right?
Mm-hmm.
You know it's coming, you just don't know when.
Right. And it's like, it's also good to know that, like, we also know a recession is coming. We don't know when. It could happen now. It could not happen now. When we're having conversations with people, and what we consistently say is you can't time the market, but you can be smart about, trimming your sales. You can be smart about saying, hey, it's the end of the year. Did you actually take some money off the table? Did you reallocate? Are you diversified? Does that make sense? I'm still completely overwhelmed by the number of people who still have a ton of individual holdings in the companies where they work. And that always makes me nervous. I never get really that nervous when people are like, I have too much in the bond market. I only get nervous when I've got too much in the junk bond market. We'll conclude our interview with Kathy Jones in just a moment. If you have financial questions, we'd love to answer them. Just go to JillOnMoney.com and click the Contact Us button. When you do that, a form will appear, you fill it out, and don't forget to check the box if you're willing to come on the air live. Jill on Money, we will be right back.
Follow Jill on Twitter and Instagram for more personal finance content. Just use the handle @JillOnMoney. Now, back to the show.
You're back. It's Jill on Money, and we are on the line with Kathy Jones. She is from Charles Schwab. She is the managing director and the chief fixed income strategist at Charles Schwab. In this last part of our interview, we asked Kathy the all-important question that I know is on your minds too, and that is, should we all still cling to this concept of a diversified portfolio? Here is the last portion of our interview with Kathy Jones. I feel pretty comfortable giving people the advice is stick to your diversified portfolio. Is that still the Schwab way?
Yeah, absolutely. Time and again, we see this. It's easy to get caught up in the enthusiasm when things are going up and up and up. And there's always sort of a narrative around it, like this is some sort of new innovation or new thing that's happening, and you have to get in on it, and the sky's the limit. And then, life, it changes, right? Trees don't grow to the sky. And so the best defense against that is having a diversified portfolio that you rebalance. And that's the hard thing to do, right? When something's going up and up, you really want to hold on to it. But the right thing to do is periodically trim that and invest in something that's not doing well. And that way you are prepared to ride out the ups and downs. And you really, really do reduce the volatility you experience. And you take yourself out of that risk of needing your money when the market is down and having to lock in your loss.
I keep saying to people, one of the best ways to battle inflation and to battle investments turning a little bit sour for a time being is to keep working. So what do you see in the workforce? Do you see maybe some of the people who left during COVID who are maybe over the age of 50? Do you think they'll be coming back into the workforce just because they feel like, I may have retired too soon?
Well, actually, we're starting to see some of that. The Bureau of Labor Statistics tracks the employment numbers, and they track the number of people retiring, and then they track what they call unretirements, people who return after retirement. And it's starting to turn up. And that isn't too surprising. I think a number of factors. Probably people retired during COVID because of all the changes that were taking place. And there's a demographic, the aging of the population. You see steady retirements. But a lot of people have come back in, and I think will come back in, partly because there is more flexibility in terms of work-life balance now. If you want to work from home and you have the capacity to do that, that could be great for a retiree looking to add a little bit of income or maybe a lot of income. The other thing is, I think I read stories in the newspapers with young people in their 50s retiring because their portfolio is way up, which is great as long as you've done something to lock in those gains. If not, you may have to come back to work to make ends meet.
And I always worry about these, and this is, of course, my own fear speaking, which is, I worry about, well, if you retire and then you're like, oh, things are great, you haven't locked in those gains, and now you want to come back into the workforce, which sounds good right this second, but if in 3 months we're in a recession, maybe you won't be able to find the job you want. So I'm always trying to caution people about thinking around the next phase. Like maybe you've got this primary career, you did it for 30 or 40 years, that's great. Maybe there's a secondary career for you. I think that in the last 3 months, I have been inundated with I-bond questions. I talked about it on TV. I never had such a response from a number of people on the staff at CBS News who were like, what are those things again? Do you think there's any chance that the government expands the I-bond program beyond that $10,000 a year limit?
I think it would be a great idea. I know there's been some talk about it circulating in Washington. I don't know that there's been anything kind of proposed yet formally for it. But if we want to encourage more savings, I think that would be a beneficial way to do it. Of course, there's a cost then to the Treasury on the budget deficit because we're going to pay a high interest rate on that at least for the short run. But I've heard chatter about it. I don't know anything about, whether it'll actually happen, but I think it would be a really positive step towards encouraging people to save more.
So overall, we're normalizing policy. We are looking at the central bank going to raise rates probably at least 1 full percentage point before the end of the summer. Do you think that the Fed could go faster? Could they go intra-meeting if things don't get under control? What's your view on that?
Well, I think they could. I think it's really doubtful that they will. First of all, I don't think that inflation is going to skyrocket from here, accelerate from here. We've already built in a lot of the increase that has built up over the last year. But secondly, it would almost send a message of too much urgency, of panic. And I don't think that's the message they want to send. I think, what the Fed's trying to do is say, look, we've got a plan to deal with this. Here it is. We're going to keep at it until we accomplish it, but we're going to keep at it at a steady pace. I really think those intra-meeting moves are so unusual in this day and age that would really kind of spark some sort of concern in the markets.
Well, thank you so much to Kathy Jones for coming on the air. She's just wonderful. If you want a link to her stuff, we'll put it in our show notes, jillonmoney.com. We will be right back. You're back. It's Jill on Money. And again, we are so grateful that we had Kathy Jones on the air with us. Gosh, she is a treasure. To conclude the program today, we'll answer one more email from Rosemarie. And she wants to know, what is our opinion of Treasury I-bonds? She writes, I understand they are now paying 9.6% interest. I also understand that there's a $10,000 limitation and that holding period. She's referring to the fact that you get whacked on interest if you hold it for less than a year, and it really is ideal to hold it for 5 years, an I-bond. So Rosemarie says, I'm 71 years old. I work part-time. I'm not a risk taker, but I am looking to earn more interest than my current CDs. Any suggestions, advice, and resources are appreciated. Well, first of all, Rosemarie, if you don't need this money, we're going to park some money. This is great. Just remember that an I-bond has two components. One is linked to the rate of inflation. That's why it's that high 9.6%. In 6 months, that inflation rate may change, and that means that the interest rate could change. So I-bonds are, the interest is calculated every 6 months. So it is fair to say, or I'm guessing at least, that the interest of 9.6% is probably going to drop down. But that doesn't mean you shouldn't do it. I'm just reminding you that that is part of it. If you are interested, the easiest way to buy an I-bond is to go to treasurydirect.gov. Now, Mark believes that it is essentially the worst government website when it comes to your finances. Maybe so, but it's the only one we got. So you're going to have to do it there. So treasurydirect.gov, follow the instructions and be patient, please. Okay, that is it for the program. We are so delighted that you joined us. Our music is composed by Joel Goodman. Mark Talercio is our executive producer. And here at the program, we do like to remind you to try to do something nice for someone else. Every time you hear our voices, we're talking a lot about money. It's a tough time. So do something nice for someone else today. It will make that person feel better, and it will make you feel better. Thanks for listening. We'll talk to you next week.